And we're back. We left off covering the impact on the different types of financial statements. So let's talk about these statements in more detail as they pertain to an accrual accounting system. Remember that the consultant revenue represents the price charged for services in year one, although we haven't received cash. But under accrual accounting, you recognize revenue when it has been earned, not based upon when cash is collected. Any expenses that incurred in order to reduce revenue are also recognized in year one on the accrual accounting system, regardless of whether or not cash has been actually paid out. Okay? In the stockholders' equity, what we showed was the change in stockholders' equity that took place during the accounting period. We showed whether we issue any additional shares of common stock, and we also showed the impact on retained earnings, meaning if we had a net income, net loss, did we pay out any dividends? These changes are all shown on the stockholders' equity statement. And then the balance sheet discloses our assets, liabilities, and stockholders' equity at a particular point in time. See, the balance sheet is as of a specific date, meaning that these are going to be our account balances on a specific date. So this is saying that total assets on a certain date equal $77,000. Total liabilities on a certain date equal $6,000. Total stockholders' equity on a certain date equals $71,000. And the statement of cash flow shows the change in cash from the beginning of the calendar period to the end. It shows what type of activities caused the change in your cash account. It shows the change coming from operating activities, from investment activity, and also from financing activity. So in our example, we see that cash collected from operating activity was $60,000. We paid out $12,000 from expenses. So 48,000 of our cash increase came from operating activity, and the other 5,000 was financing from the issuance of common stock. So as a business, it's important to not just understand whether cash increased or decreased, but to also understand what factors led to the increase or decrease to your cash account. This is a comparison of accrual accounting to the cash flow. So with accrual accounting, it's showing total revenue at $84,000 because under accrual accounting, you recognize revenue when it's earned. The cash flow shows the actual cash amount received or paid out. That's a difference. Accrual accounting is a more accurate deflection of the business transaction that took place for an accounting period. So under accrual accounting, you're showing net income of $66,000, but under the cash flow, we will only show $48,000 because the cash flow only shows cash receipts, cash coming in, or cash outflows. But once again, accrual accounting shows the actual transactions that took place. That's why if you're a public corporation, you must use the accrual accounting system to record your business transaction. We're going to cover next something known as the accounting cycle, which is a series of steps that will take place during the accounting period. But first, recall in chapter 1, we talked about that certain accounts are temporary while other accounts are permanent. If an account is temporary, that account only shows information for that specific accounting period. For example, it is now tax time. If you think about your W-2 form, That W-2 form shows the income you earn for a specific year, such as 2024. The next year, you begin with a zero balance as it's going to accumulate. So when accounts are temporary again, they only show data for that accounting period. They're going to be closed out at the end of the accounting period. If an account is permanent, it means that the account balance will carry forward from one accounting period over to the next accounting period. So the accounts that are temporary are expenses, dividends, and revenue. Those accounts only show balances for a specific accounting period, but the accounts that are permanent are your liabilities, assets, and your stockholders' equity. So, for example, if at the end of the year you have 10,000 in your cash account, that 10,000 in the balance will become your cash account beginning balance for the next year because that account is a permanent account. Okay? So we're going to look at how do you close out those accounts that are temporary, which are your revenue accounts, your expense accounts, and dividends. So what happens is that the balance of those accounts are going to be transferred over to retained earnings. For example, look at your revenue. Revenue for the year was $84,000. We're going to take that $84,000 from revenue, and you see, put into retained earnings to become part of our permanent accounting records. So now consulting revenue is going to be zero once it's closed out, and that account is now ready for the upcoming accounting period. The same true for the expenses. Salary expense was $16,000. We're going to put $6,000 in the account to close it out to give it zero balance, but that $16,000 goes over to retained earning. And the same holds true for the advertising expense account, the same concept. So now these accounts have been closed out. They're all going to be ready for the upcoming accounting period. Retained earnings is a permanent account. So this balance of $66,000 at the end of the accounting period will become the beginning balance for the upcoming accounting period. Therefore, any account that is temporary, revenue accounts, expenses, dividend, are close to retained earnings at the end of each accounting period. Okay? So these are what we call the steps of the accounting cycle we've covered in chapters 1 and 2. First, you record your transaction utilizing the account equation. You make any required adjustments at the end of the accounting period to make sure that any revenue earned has been recognized, all expenses have been accounted for, and once you make those adjustments, you then prepare your financial statement. You prepare your income statement, retained earnings statement, stockholders' equity statement, as well as your statement of cash flow. And then at the end of the accounting period, you're going to close out any account that is temporary to get prepared for the upcoming accounting period. And then next year, guess what? We do it all over again. Okay? There's a concept called the matching concept that says you want to match revenues and expenses in the same accounting period. So what does that mean? Let's say we're in 2024 and we earn revenue of $100,000. We're saying any expenses that incur to earn that revenue should also be recognized in 2024, whether they have been paid or not. So with the cash basis of accounting, it can distort the measurement of net income because it fails to match expenses with the revenue. Meaning that you could have an expense that had already taken place, right? But with the cash basis of accounting, you don't record the expense until the cash is actually paid out. which might not represent when the expense actually took place. The same for revenue. Remember the one problem where we provide the service for $84,000 and they didn't pay us yet? Under the cash basis, we only show $6,000 in revenue, although we actually earned $84,000. Therefore, accrual accounting is more aligned with the matching concept. And again, if you are a public corporation, you must use accrual accounting in order to recognize your business transaction. We'll now move on to deferrals. When you have a deferral, it's a delay in the recognition of a revenue or an expense. It means cash may be exchanged before revenue or expense is recognized. So now we're saying that cash has been received, but we haven't recognized the revenue or expense just yet. Perhaps you're saying, why would that take place? Well, let's see. Cato pays $6,000 to the instructor to settle the salaries payable obligation. Now, this is going back to year one. If you recall, we owe the employee $6,000 at the end of year one. We're now making that payment. So we're going to decrease our cash account and decrease salaries payable. Now, this transaction doesn't impact the income statement because the expense was already recognized in year one. It will impact the statement of cash flow because it's an outflow of cash of $6,000 shown as an investing activity. Okay. Now that was not a deferred transaction. I'm going to show an example of a deferred transaction in a few. Next, we purchase supplies on account for $800. Now supplies are an asset. Supplies are something of value that are owned or controlled by the company. So our supplies account increased by $800. However, when it says supplies on account, that means we haven't paid for the supplies yet. We still owe for the supplies. We have a liability. There's an account called accounts payable that shows money owed to our suppliers. Again, accounts payable shows money owed to our suppliers. So the assets section increased by $800, but your liabilities also increased by $800. The account equation must always be in balance. Again, your assets must equal liabilities plus stockholders' equity. Notice that this transaction does not impact your income statement, nor does it impact your statement of cash flow. Okay. Now, after determining through a physical count that 150 of unused supplies on hand as of December 31st. So what does that mean? Well, remember, we bought supplies at a cost of $800. We're saying at the end of the period, supplies with a value of 150 are actually remaining. That means the amount of supplies used totals $650. Now, initial supplies are shown as an asset. However, once supplies have been used, that cost now becomes an expense. All right. So your supplies account would decrease by $650. Your expenses are going to increase by $650. So on the income statement, yes, there is an expense for $650, showing a net loss because cash was not involved in this transaction. It does not impact your statement of cash flow account. Okay? So try not to give you too much at one time. So review this video and come back and get prepared for the conclusion of our chapter 2 video lecture. Bye.